Hello friends, before I begin this video, may I request a few seconds of your time? No, it's not what you think it is, but it's as important. You see, those of you who've been connected with me for long enough have given me a lot of love and affection and have appreciated my work on television interviews, print and electronic media articles, etc. And you know me as a pure prop trader, which I have been doing since 1986. So you see, we focus on doing things, which is why we have zero idea about digital marketing, about advertising, or how to reach our work across to a bigger segment of the audience. But we want to keep our work free. And just because it's free, it doesn't mean it should not reach out to a whole lot of people. Can we depend on you to give us the word of mouth and other push like sharing our work with your social media platforms, with your social media groups, etc., so that we can reach out to a wider audience and spread the virtue of knowledge? If you can do that, it would be absolutely great for us. Now, let's dive right into the video. Hello friends, welcome to our weekly market outlook video. Well, last week we saw how the markets were basically preparing to hit a new high in the month of March, thanks to the big boys of the market, the mutual funds, basically coming out there to prop up their NAVs. Now, the markets did gain on a week on week basis, but the volatility was frankly unnerving. It is something that I've been writing about and expressing my concerns in my weekly live mint column, in my money control column, as well as these videos. So, even if the market was to rise on a net week on week basis, are you making similar kind of returns? What I mean is, if Nifty is going up 3% during a week, hypothetically, are your profits rising that much? If not, what is the remedy? Well, let me tell you a short story about how Mexico does this. Now, Mexico basically is a member of OPEC, and it is known to violate OPEC's export quotas very frequently. Now, the reason why they can get away by doing this is known in Wall Street as the Hacienda hedge. Hacienda means a villa. Now, Petróleos Mexico's, the Pemex headquarters are in a villa in Mexico, and every year Mexico places billions of dollars worth bet on Wall Street, buying tail risk hedges. By tail risk hedges would mean, say, if oil is trading at $80 a barrel, they would buy put options at $10, $15, and $20 a barrel. Because the puts are so deeply out of the money, the premium tends to be small. But hey, if prices fall, the puts become valuable and they give them above normal multiplying returns. So Mexico keeps pushing physical oil into the oil market, and if prices fall, which they do because Mexico is a large producer, they make money in the Hacienda hedge. Now, this strategy is called a tail risk hedge in the options market. So supposing you're buying the Nifty futures to trade at say 22,200, if you were to buy a put which is deeply out of money and which is available at pennies to the dollar, you are basically replicating Petróleos Mexico's or Pemex's Hacienda hedge. This is something that I think you should be enforcing to protect your profits in highly volatile markets like ours. So friends, this aspect of the market done. Let's now go to our regular weekly market outlook coming up on your screen now, the market roundup. As you can see, it was the Bank Nifty which led the rally, and the Nifty 50 brought up the rear. The US dollar index fell 31 basis points, and that was basically a reason for cheer in emerging markets, including India. Gold went up due to a weak dollar, but silver came down due to basically profit taking. Do remember, silver had made outsized gains last week as compared to gold. Natural gas prices went up marginally, but crude has come down significantly. Do remember my online family members who are connected with me on a free Telegram channel. That's one place where I share all my thoughts under one roof. I have been warning you through various data points, various research notes, and various charts that I'm expecting crude prices to come down. And lo and behold, Friday was the crowning glory. Crude fell over 2% in just one trading session on Friday. It's been weak throughout the week. So, more updates on our Telegram channel there. Now, the USD INR, which is the United States dollar versus the rupee, it fell against the rupee. That means the rupee was stronger vis-a-vis the dollar. And the Indian 10-year benchmark bond yield fell by 2 basis points, which means bond prices rose. Now, that is one reason, one of the many reasons rather, why the bank nifty went up, because bonds are something banks invest the most, and when bond prices go up, there's a mark-to-market gain. The NSE clocked 0.88% in market cap gains, and that means the rally was fairly broad-based. MWPL or market wide position limits crossed 41% and closed at 41.17. This is a multi-month high, and that tells you risk appetite has increased. The US indices rallied across the board, and the biggest gains were notched by the S&P 500, which also happens to be the most broad-based index out of the three covered here. So that tells you that we got tailwinds from the US market. Now look at the inset box here. For many, many months, I have been warning you that interest rate sensitives, especially banking and financial sector stocks, are underperforming the broader markets represented by the Nifty 50. Now, for the first time in many months or many quarters rather, the bank Nifty over a 4-week time frame has given you higher returns than the Nifty 50. Of course, over a 12 and 20-week time frame, the bank Nifty's gains are smaller, but this is the first time the bank Nifty is returning higher profits over a month in tenure. That tells me that banking and financial sector stocks are attempting to play catch up with the broader markets. Why is this important for you? You'd ask me. The reason why it's important for you is because banking and financial sector stocks command a 33% weightage in the Nifty 50. So that makes a lot of difference to the Nifty itself. Now come to the second chart, the MWPL market-wide position limits. This indicates how much of exposure traders have utilized as compared to the exposure allowed by SEBI. You can see that at 41.17, the MWPL is the highest in many months. That tells you that check writers, swing traders who basically don't square up their trades intraday, they roll them forward, are taking bigger exposure. Now, A, conviction levels are higher, but B, MWPL rising will also bring volatility. Why is that? Because whenever trades get squared up, since the exposure is big, squaring up is also big ticket or large sized in trade volumes. So prices move around very, very exaggeratedly. This is something that you're seeing on your screens day in and day out since the last fortnight or so. Let's now come to the turnover. This is a turnover of 3 consecutive expiries, that is February, March, April. What you are seeing is index futures recorded a lower turnover because traders were focused more on individual stock futures. That basically tells me that risk appetite was higher because stock futures demand more by way of span margin, mark-to-market margin, and are more volatile. So traders were clearly getting more aggressive, which in a way is good. Now let's come to the advanced decline ratio. What you are seeing is the Nifty clocking smaller gains on a week-on-week basis, and the advanced decline ratio also fell from 1.23 in the prior week to 1.02 last week. Now, the advanced decline ratio indicates the risk appetite of intraday traders. Intraday traders were clearly on the fence. They were sitting cautiously, although the tilt was towards buying. But for every 100 losing stocks, there were only 102 gaining stocks. That tells you that the bulls just about managed to dominate the sentiments. This advanced decline ratio needs to improve if the markets were to make more gains in the week ahead. Now, friends, I come to the prompt futures basis of the Nifty and the Bank Nifty. What is basis? It's the premium or discount prevalent to spot of these two indices in the current month futures. Obviously, risk appetite is one thing it reflects, but it also reflects time remaining to expiry. Now you have 4 sessions left in the coming week. Fourth one, of course, is the expiry session. So futures price tends to converge with spot, and that is exactly what you're seeing. Bank Nifty and Nifty have seen a significant erosion in the basis, which is normal. As long as the basis is positive, which means the futures are trading at a premium to spot, bulls are still in control. You should worry only if the futures are trading at a discount to cash. That is not happened yet. So far so good. Bulls are still in control. Friends, I now come to our exclusive in-house indicator, the impetus, which you have been trusting for over 3 years in a row now. And what you are seeing is that the impetus reading for both the indices was higher, in addition to the prices rising last week. That tells you that overall there was higher momentum on both the indices on the buy side. That tells you that participation was fairly good, and should it continue, I think both the indices can head higher in the coming week. Now, friends, let's come to our exclusive in-house indicator, the LWTD, the lift weight thrust drag indicator. You won't find this anywhere on the internet, and you've been trusting this for almost 3 years now, and the level of accuracy is fairly good. I mean, at least 7 times out of 10, this indicator has lived up to our expectations for daily and weekly charts. What you are seeing is the LWTD indicator has jumped back above zero after staying below the zero mark for 2 weeks in a row. From minus 0.03, it has closed at 0.25. Even though the Nifty has come down, the LWTD has jumped up. What does it tell you? It tells you that at lower levels, short covering should be highly likely. And that is basically also indicated by the fact that Thursday, the 29th of February, is expiry. Normally, it is longs that are rolled over, and shorts in terms of percentage of rollover are smaller as compared to longs. So short covering will cushion declines as far as data present with us till now is concerned. Friends, our in-house indicators done. I now come to the bond market, which is very close to my heart. I have been covering bonds ahead of equities for many years now, because this market funds all the other asset class markets. What you saw was the Indian 10-year benchmark bond yield came down last week, and it's been under pressure since the last month. What it tells you is that our GILT funds that we deployed money in on 14th of December 2023 are near lifetime highs. As a matter of fact, lifetime highs were made last time on Thursday, the 22nd of February 2024. Friday, there was a marginal dip, but we are still near all-time highs, lifetime highs. And what you are seeing is the percentage change since the time the recommendations were made are in ascending order. The highest gains have been made by Aditya Birla Sun Life GSEC Growth Fund as compared to the recommendation date on 14th of November. And that tells you that our in-house statistical model, the IBEX, has been getting the bond convexity issue right. Now, bond convexity is the factor that measures A, the direction of the bond price, and B, the sensitivity of the bond price to the change in interest rates or expectation of interest rates. So we've so far thankfully gone right where convexity metrics are concerned in our programming. I do suggest holding on to these gilt funds as of now. And whenever there is time for an update or time to switch or time to do yield flipping, the first place you will get an update is our free Telegram channel. My contact coordinates come at the fag end of this video. Please connect with me there. Friends, the bond market's done. I now come to the Bank Nifty, which, as you can see on the daily chart on your screen, gained 0.92%, and in the bargain, it rose on 2 out of 5 trading sessions. Tuesday was a decisive day which determined that the Bank Nifty closed with net gains for the week. The price is above its monthly moving average, which itself is turning higher. The 46,370 level, which I advocated last week as a hurdle, was not violated, which now has become a short-term support. The 46,370 level will be a support to watch in the coming week as well. Moving on to the weekly chart, what you are seeing is an inverted bullish hammer. Now that is a mild concern because what an inverted hammer tells us was the price attempted to move higher, but there was resistance at higher levels, and therefore the closing price of the week settled in the lower half of the week's range. It's nothing that follow-up buying cannot really counter. Now the price is above its 25-week exponential moving average, which is a good proxy for a 6-month long holding on cost. And the medium-term outlook, therefore, is positive for now. The last week's high of 47,364 level must be overcome in the coming week to put the bulls firmly back in the driver's seat. As the small inset box on your screen tells you, the Bank Nifty is showing signs of catching up with the Nifty 50, and should this buying momentum continue, I think the Nifty itself will get a boost from the Bank Nifty thanks to the 33% weightage of banking and financial sector stocks in the Nifty 50. Now, week before last, this index was number 5 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It jumped 2 notches to number 3. Now, a sectoral index rising up on beta rankings, not good. Not good for traders because volatility will go up. Do remember the Hacienda hedge or the tail risk hedge that I mentioned in the initial part of this video. Now, last week I advocated an estimated range between 47,825 on the upside and 44,925 on the downside. The index gyrated splendidly within these parameters. In the coming week, I estimate a range between 48,225 on the upside and 45,400 on the downside. Friends, in addition to all these, please also monitor our daily, weekly, and monthly pivot levels, both in the equity indices segment and the commodities segment on our free Telegram channel to get more accurate resistance and support levels. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 0.78%. And as you can see on the daily chart on your screen, this index rose on 3 out of 5 trading sessions. The price is above its month-long moving average, which itself is moving higher. The Fibonacci extension level of 261.8% at 22,200 was overcome, but the price is still poised somewhere around that level itself. So it's acting as a chaotic attractor. What we need is the price to trade sustainably above this level and close above it continuously. And with the banking sector catching up with the broader markets, there is hope of exactly that happening. Now, the weekly chart on your screen tells you that the price has seen a bullish candle which shows bears attempted to drive prices lower but failed. If follow-up buying support comes in during the week and the high of 22,298 is overcome on a sustained closing basis, I think you're basically solidifying the probability of the Nifty and the Bank Nifty. Both, right now it's only the Nifty, but even the Bank Nifty will be hitting all-time highs. we need to cross over these hurdles. In the coming week or few weeks, the 21,450 level is an immediate support to watch out for. The higher beta is presenting a challenge to traders, which is why markets are rising, but your trading profits may not be keeping pace in lockstep with the headline indices or even the stock percentage gains. Now, this is where the hacienda hedges come into place. In the week before last, this index was number 16. It jumped 5 notches to number 11. Now, do note, I've been telling you that statistical beta is rising at a pace which retail investors may not be capable of handling very easily. So, do be careful out here. Last week, I estimated a range between 22,550 on the upside and 21,525 on the downside, which held perfectly well. In the coming week, I expect ranges between 22,725 on the upside and 21,700 on the downside. Friends, do watch our daily, weekly, and monthly pivots, both on indices and commodity futures, to get a better handle on exact levels of support and resistance. Friends, I now come to the last bit of statistical analysis in which I gauge the retail risk appetite by way of the contribution of the 4 segments to the overall turnover of the market. Now, as you can see on the weekly chart on your screen, index futures turnover went up by 0.01%, which is indicated by a blue line. Stock futures turnover also went up by 0.04%. It's indicated by a red line. Now, do remember, futures are more capital intensive. They demand more span margins, mark-to-market margins, and other extreme loss margins. So, people were actually taking bigger risks by playing more in the future. In index options, we saw a decline of 0.21% in the turnover contribution. It is indicated as a green line. And in the stock options, we saw a 0.16% gain in the turnover contribution. It is indicated by a purple line. Now, friends, the fact that in the option segment, traders were placing more bets in individual stocks which are more volatile, they demand more money by way of a span margin for option writers or options premium for options buyers. Here again, in the option segment, risk appetite appeared to be higher. So it's not a question of risk appetite not pushing the markets. What we do need is follow-up buying coming in. Now, friends, I share my trading strategy, which is going to be briefer than other weeks because of the high volatility. First, foremost, and always, I will be trading light because statistical beta, frankly, is spiking exponentially. I want to play safe. It would be a good time to implement the hacienda hedge or the tail risk hedge, which I talked to you about. I continue to seek theta decay opportunities in oil and gas, which I have been maintaining as bearish, but they are going up only because of man-made supply shortages in the short term due to Russian elections on 17th March and Saudi Aramco's touted follow-on public offer of shares. Now, once that is done, it's going back to mean reversion, and I promised you on my free Telegram channel that I would be making a detailed video on the oil trading opportunities in this background. Remain assured, it's work in progress. I'm working on it, and that video will be uploaded fairly soon. PSUs and PSBs remain in the central point of the trader interest. Volatility will mean opportunities will exist both ways, on the long and short, in these counters. But like I said, you need to play very safe. Hacienda hedges, please, and small exposure. And I would choose to take the market as it comes rather than covering too many sectors in this trading strategy. I would say I would play it by the year. I'll let the market tell me where it's going and then update my ideas on our free Telegram channel as the market moves forward. Now, do connect with me on our free Telegram channel. That's where I share all of my ideas. Friends, before I bid goodbye to you in this video, A reminder to subscribe to our YouTube channel if you haven't already done so. In the comment segment, do let me know what you think of this video and what we can do to help you become better traders in our future videos. Do share our videos with fellow like-minded smart traders like yourselves on your social media groups, friends, family, and others. I thank you for your patience in being with me in this video till we meet again in our next. This is Vijay Bambani signing off for now. I wish you have a very, very profitable trade ahead. Take care. Bye-bye.